Everyone, so welcome to our video presentations today. First, my name is Lim Che Yang 294927. Thank you. Can you introduce yourself? Yeah.
Hi, my name is Naki bin Mahdi, number metric 298,494.
Aida?
My name is Nur Aida Iwana binti Syabdullah, number metric 294804.
Rashidi?
Okay. My name is Muhammad Rashidi bin Maklela. Metric number is 298628.
And lastly, Alif.
Hi, my name is Muhammad Fazil Ali bin Shalim. Metric number 301842.
Okay, so welcome to our video presentations, and in this video, we will be discussing key components of financial statement, including the statement of profit or loss and other comprehensive income, the statement of owners' equity changes, and the statement of financial position.
We will also explore common adjustment and how they impact the accounting equation, followed by a discussion on real-world business and accounting issues. This presentation aims to enhance our understanding of how accurate financial reporting support effective decision-making in any organization.
Shidi?
Okay, all right. Let's start with the segments of profit or loss. So the total sale is RM 1 million, but we have to minus sales returns of 4,000 and sale discount of 10,000. So that give us net sales of 986,000 ringgit.
Okay, so 986,000 ringgit is what we will work with as net sales. Then the next is cost of goods sales, right?
Yes, I want to take that.
Sure. Under COGS, we have got 500,000, and that is the cost of merchandise sold.
All right, then after that, we go into operating expenses. We usually split that into selling and administrations, right? So Nekyu, you want to go through the selling expenses?
Yeah, sure. So selling expenses, we have got advertising for 35,000 ringgit Malaysia, sales salaries 90,000 ringgit Malaysia, sales supplies 9,000 ringgit Malaysia, depreciation for office equipment 15,000 ringgit Malaysia, depreciation for the delivery van 40,000, repairs and maintenance for 10,000 ringgit Malaysia.
Okay, and for admin expenses, we got office salary 30,000 ringgit Malaysia, office supply 6,000 ringgit, and lastly insurance expenses we got 20,000.
Okay, and don't forget the others expense. Rental is 40,000, utilities 28,000, and interest expense is 22,000. All of this will be minor from the revenue to get the final net profit.
All right. So that wraps up the income statement. Now let's move on to the changes in equity.
Okay, so for the statement of changes in equity, we start with capital of 700,000.
Then we add the net profit from the previous statement and minus with any withdrawals. I think the withdrawals are 20,000, right?
Yes, correct. So the final figure we get is the closing capital, which we will carry forward to the balance sheet.
All right. Let's go to the statement of financial position.
Okay, so in the financial position statement under asset, Shidi, want to handle current asset?
Sure. Here was we have got. The cash is 568,000. And account receivable is 120,000. Inventory recorded 350,000. Office suppliers is 5,000, and sales suppliers 80,000, and last prepaid insurance is 60,000.
Then for non-current assets, we have long-term investment for RM 200,000, office equipment 250,000, less depreciation 150,000, delivery van for 400,000, and less depreciation with RM 220,000.
Okay, I will cover for liabilities. For current liabilities, the firstly, accounts payable, we got 300,000 ringgit, and salary payable, 30,000 ringgit. Interest payable, we got 25,000 ringgit. Lastly, net revenue, 50,000 ringgit.
And don't forget the long-term liabilities, which we have the notes payable of 400,000 ringgit.
Then lastly, under equity, we include the closing capital that we just calculated in the statement of changes in owner's equity. So that completes our statement of financial positions. Let us proceed to part B.
Now for part B, this is about the adjustment that were missed. First one is the depreciation of 40,000 not recorded. What happens if we skip that?
Oh no, our asset will be too high and net income also will be overstated.
Right. Next is unpaid salary of 25,000.
If we didn't record that, liabilities and expense are understated. So against net income ends up higher than it should be.
Exactly. And for office supplies, left is only 500, but the balance hasn't been updated.
So asset is overstated and expenses are too low.
There's also 9,000 of unearned revenue that should now be recognized.
If we leave it as net, we overstating liabilities and understating revenue.
Next, for the expired insurance of 45,000, still shown under assets.
Same case, overstates asset and understates our expense.
Also, 30,000 of sales was not invoiced.
Okay, so revenue and account receivable are both understated.
And we have 20,000 of interest income unrecorded.
Again, that causes income and assets to be understated.
For the last one, we have 150,000 of supplier invoices were not recorded.
That means both liability and expenses are too low, and net income is again overstated.
So overall, not adjusting these items lead to a financial report that doesn't reflect the true position of the business. Okay, so it's very important that we concern about understated or overstated expenses as well as revenue. Okay, now let us proceed to part C. Okay.
Okay, let's move to part C. The first issue is about revenue recognition for gift cards. From an accounting perspective, revenue should only be recognized when it is earned. That is, when the gift card is redeemed, not when it is sold.
Okay, and that's to recognizing in at the time of sale would misstate income and uh, violate the matching principle.
Now, regarding depreciation methods, the two common approaches are the straight line and the declining balance methods. Alif, which do you think is more suitable for delivery vans?
For delivery vans, I recommend the declining balance method, as the asset tends to lose value faster in its early years.
And for office equipment,
In that case, the straight line method is more suitable because the value reduce evenly over time.
Using appropriate methods for different assets give a more accurate reflection of their value in the accounts.
All right. Now, the issue of obsolete inventory. The business face losses because of stock becoming outdated before it could be sold. What can be done to avoid this?
Okay, they should improve inventory tracking, maybe by using software and only order based on demand forecasting.
so implementing a just-in-time inventory system can reduce the risk of inventory become obsolete or overstockings.
And for items already obsolete, offering discount, donating to charity, or recycling are practical option to minimize losses and clear storage space. To conclude, preparing and analyzing financial statement is essential for providing a true fair view of a business financial position. Through this presentation, we covered the major component of financial reporting and highlighted how adjustment and accounting issue can significantly affect financial accuracy. Whether or not we are in the field of accounting, understanding this concept is important in today's business environment. Thank you for watching, and we hope you found this presentation informative and insightful.
Thank you so much, everyone. Thank you, Dr. Shaudatu. Thank you.
Thank you.
Bye-bye. Okay.
Bye-bye.